Hello everybody. So in today's video, I just wanted to give a valuation update on 4 stocks that I've covered before on this channel that have recently, either this week or this past week, reported their earnings. And all of these stocks did very well, but I'm not going to dig deep into the earnings report because, again, you don't need anybody to read the report for you. I'll sum it up to this. Airbnb was good, and I'm happy with my position in Airbnb, although I'm not growing anything with Airbnb. Rover and Datadog were great. I am not going to be adding anything to Datadog, though, because I don't like that valuation. Rover, I am looking to add and start building a position. I have just a starter position, something meaningless. I am looking to add to Rover. They both did great earnings. And then we add a downright unbelievable earnings in TransMedics, ticker symbol TMDX, where after their earnings, after reporting Q3, they were up 51% in a single day. I've never seen this. Up 51% in a single day in a normal market outside of a crisis. I've simply never seen this. This is crazy, just on an earnings report. So briefly, let me walk you through my spreadsheet and what I did here with this spreadsheet. So you may recognize my usual spreadsheet. So in this usual spreadsheet, what's important is enterprise value over trailing 12-month gross profit over revenue growth. What this computation right here calculates, and that's this division right here. Right? So what this calculates is how much am I paying for each percentage point of future growth. And the question that I'm asking here is, how much am I paying for that 1% of growth? Well, what am I looking for? I'm looking for paying as little as possible for each percentage point of forward growth. I don't want to pay a lot for forward growth. So when you look at this, you can see that Datadog, you're paying a lot for that forward growth with Datadog at a 0.58. Airbnb, you're paying a lot too, not as much as Datadog, but you're paying a lot. So Datadog valuation is in line with actually a Tesla. If you look at the EV over GP over revenue growth. And again, it may be a lot, it may not be a lot. It depends on what you think. It depends on what you compare it to. But compared to the two other very cheap small caps on this video, which are Rover and TransMedics, we can see that the big caps here, Datadog and Airbnb, are much more expensive. You can also see it, for example, in the price to sales. When you look at the enterprise value to sales for Datadog, quite an expensive stock. Airbnb actually fairly reasonable, trading in line with a Tesla at a 7-ish enterprise value over sales. So let me show you though the new part of the video, and based on all of this, we can see that the cheapest stock is TMDX, despite the run-up, right? This enterprise value includes the 50% run-up that they've had yesterday. Despite that, it is still the cheapest stock because analysts are predicting 114% growth. This is a stock that reported trailing 12 months over 150% in revenue growth. This stock is growing like a weed at a 69% gross margin while they operate in the brick and mortar space. So that would be the cheapest. TMDX would be the cheapest here out of the 4. What I want to show you that's new in this spreadsheet is because I have a lot of SaaS. I have one SaaS companies, but I also on other spreadsheets I talk a lot about SaaS companies. One thing that people do in SaaS is they look at this rule of 40, and what they'll do is they'll usually use net profit margin, and they'll add net profit margin to revenue growth and long-term revenue growth and long-term net profit margin. When you add the two, you got to get more than 40. And if you get more than 40, it means you're a great stock, essentially. And so it gave me this idea of using kind of my spins on the metric here. So as you know, I use not long-term revenue growth, I use forward revenue growth, next 12 months. So I'm adding the next 12-month forward revenue growth to the next year's EBITDA margin. So I calculate EBITDA margin here by taking what's the EBITDA margin at the last quarter, the last reported quarter. So in the case of these companies, Q3, I'm taking that last quarter EBITDA margin and I am multiplying it by how much analysts expect EBITDA to increase over the next 12 months. And that's where you get some stocks that we know are complete cash machines. Like, for example, Airbnb, they expect next year 32% EBITDA margin. So absolutely a cash machine. And why do I use EBITDA? Because EBITDA is a proxy for cash flow, right? So absolutely a cash machine. Rover, same thing for Rover. 36% next year EBITDA margin. Absolutely outstanding. I mean, we are getting into the realm of very profitable stocks here. If you look at Datadog, same 31%. So for Datadog, I used free cash flow because due to their accounting, EBITDA is not coming out positive. So I used free cash flow for them, but it's somewhat of a similar metric. Sometimes you gotta adjust. And if you look at free cash flow for Datadog, the next year's free cash flow margin will be 31%. For TMDX, we're not there yet. We're not there yet. It's not applicable yet. They are not cash flowing just yet, but they will in a few quarters. They will. So what I do is I take these EBITDA margins and I add them to the next year revenue growth, and I get to this number. You add the margin to the revenue growth, and of course, the higher number, the better. And when you look at this, unbeatable would again be TMDX. When a stock is predicted to grow at 114% a year, theoretically, if the price to sales or EV to over sales remains constant, if the ratio remains constant, theoretically, you're gonna make 114% a year. Theoretically. So this is a stock that's going very, very fast, and growth trumps all. Like the market was shocked at 114%. So I'm going to do a deep dive because 114%, that's the prediction now. The analysts are going to come back and update those predictions, right? But it seems like they did 150%, over the last 12 months. So I'm going to do another deep dive and revisit the stock. You may remember when I analyzed this stock, I decided to stay out because I was feeling uneasy about organ transplants. But many of you brought up things in good comments in the comment section that really make me want to revisit. So I will be revisiting TransMedics because it wins in this spreadsheet. And of course, the 50% off, who knows? Who knows if TransMedics, a month and a half from now, the stock is not going to be forgotten by the market and quote unquote left for dead again. No bad pun intended here. Left again by the market because it's ignored, because small caps are ignored, quite simply. Rover has had outstanding performance over the past few months. Rover is turning out to be a very interesting niche business. One of the bigger. So if you do, in a nutshell, if you don't know what Rover does, Rover is essentially an Airbnb for dogs. It's very interesting in the sense that people who own pets, right, dogs and cats, whenever they travel, they typically don't bring their pets. And in the past, you had to ask your friends to take care of your animals, or you had to ask your family members. Today, Rover is taking over that former mom and pop way of doing things and adding a layer of trust where you can just board your dog, board your pet with another family and pay them a nominal fee like $20 or $30 a day. And of course, Rover takes a very nice margin on top of that, and it serves as trust between both parties. It's a very interesting niche play, especially as there's tremendous trends towards pets adoption, and more people have pets and getting more pets, and this has been a long-term trend in the making. So it's always been an industry, especially in the US, that has fascinated me. And Rover, as an avenue for growth where they could easily 20x their size. Easily 20x their size. I mean, it's still not a mainstream name. Even among pet owners, it's still not a mainstream name. It's a huge market, and they're getting into Europe, and it seems like they're beginning to win in Europe as well. So I like Rover very much as a niche platform, and the stock is very cheap at a 0.19. It's very cheap, just along with TMDX. Also very cheap in my way I analyze stocks. briefly, if you're new to the channel, the way I look at stocks is I look at product adoption. I want to have signs of product adoption and signs that these stocks are going to follow the product adoption curve. They are going to follow that S curve of product adoption. And clearly, when I look at a stock like a TransMedics or a Rover, they are early on in that product adoption curve. And these two stocks rank the best on revenue growth plus next year's margin. So on the quote-unquote rule of 40, they're well over rule of 40, right? I mean, TMDX is almost triple rule of 40. Rover is almost double rule of 40. So in my view, these stocks will do very well. And then I have two more mature stocks. I'm not adding to any of these stocks, right? I said I was looking into adding a little more for Rover. Rover, I have a tiny position. TMDX, I don't have a position, but I will be studying this more closely because that growth rate is stunning, and the stock may be cheap with that type of growth. The stock may be cheap. As far as Airbnb, Airbnb. There's a lot of headline risk with Airbnb, and I think one of the reasons why the stock is not as high as perhaps it should be is because of this headline risk. Like if you were following the stock yesterday, there was this lawsuit in Italy saying they haven't paid $800 million in back taxes or something like that. I mean, it's a classic for American companies to get fined in Europe. That's kind of a rite of initiation to the European market, kind of a welcome bonus when you go to Europe. You get big fines, cost of doing business. But nonetheless, this gives a really bad sentiment over the market. It's like, oh, $800 million fine. What are they going to pay? What are they not going to pay? Well, they're fighting it in court. But every time you have some of this news, it gives an overhang on the stock. So in a way, this would be a good time to accumulate Airbnb, except I'm not adding to Airbnb because the growth right now is at 22%. When I bought this stock was growing much faster. It's now predicted to grow at 22%. So it's really not enough for me. So that's why I'm keeping the stock, long-term hold, but I'm waiting for that growth to pick back up for me to add to Airbnb to be above 30%. That's what I look for. And the last stock that, again, anytime I do a dedicated video on the channel, I get very little views, which is why it's all in this video. The last stock is Datadog. You maybe remember this analysis in the early days of the channel. I had a 90 views on this video. It was one of the more early days, and I explained why I was so bullish on Datadog, and what you find is that Datadog is really winning the data monitoring infrastructure, application monitoring, DevSecOps space. That is a space that they're winning, and they've seen their competitors either get taken private or get acquired. Like Splunk was acquired by Cisco. So if you follow Datadog, they're kind of the leader and they're kind of the main play in town left. So that's why the growth at Datadog is accelerating. And Datadog yesterday, they announced that the moderation in spend in IT is mostly done. They are not seeing the IT professionals spending on their platform. They're not seeing them being cautious anymore. So, and the CEO sounded very bullish on the call. I listened to the call. The CEO sounded very optimistic about the future. That's why all of the SaaS stocks were up, because it seems like companies are back into their normal spending mode, right? As if they were going to stop spending on critical IT and tech forever, right? No, they were not going to do it forever. So they had halted spending a little bit, but no, it's not. Now it's not forever, and it's getting resumed. If you follow my channel, you know that I'm big on Enphase and solar. I believe Enphase and solar will be the same way. Give it 6 months, give it 9 months. There's a pause. People are waiting to see what's going to happen with the interest rate, but then they will resume their purchases, and this is to a lesser extent the same with EV adoption and Tesla and electric cars. It's like, yeah, people are a little fearful. You can postpone spending on stuff for 6 months, but you're not going to postpone for 5 years, if that makes some sense, right? The demand returns and reverts back to normal over time and as we have more visibility into the economy. So anyways, a little bit of a different video. No dedicated video on any of these earnings because there's so much to cover right now and I have limited time. But just know that Airbnb was great. Rover and DDOG for me was great. Airbnb was good, actually, not great, good. Rover and DDOG was great, and TMDX, simply unbelievable. I need to cover that stock again, and I want to spend that time covering TMDX again. If you want some commentary on these videos, remember I do every other week I do my most undervalued stocks video, and that's where I give a little commentary about each of these stocks. At least Airbnb, and I'm thinking about expanding the video on other stocks. Anyways, this was not investment advice. This was just entertainment. I hope you were entertained. Thank you for liking the video. Please subscribe and have a wonderful day.